All right, let's dive right into something you hear about all the time, but that can feel super complicated: tax avoidance. Today, we're going to break down the puzzle of how governments try to make sure everyone pays their fair share.
Right? It's a question you see everywhere. You'll read a headline about a company making billions in profit, and then a shockingly low tax bill. So how does that happen? Well, it usually comes down to a very complex and often perfectly legal game of strategy.
Okay, first things first, let's get a really crucial distinction straight. We are not talking about tax evasion. That's the illegal stuff, hiding cash, lying on your forms. What we're digging into is tax avoidance. This is all about using the existing laws, and yeah, there are loopholes, to legally pay less tax. Think of it as this constantly evolving puzzle, where companies find new ways to solve it, and governments keep trying to change the pieces to keep the game fair. So, how do governments push back against tax planning that gets a little too aggressive? Well, their first major weapon is something called the General Anti-Abuse Rule, or GAR. You can think of it as a powerful smell test for any business deal.
This one phrase from the law is really the heart of the whole thing. It asks a simple but very powerful question. Does this business arrangement exist for a real, genuine commercial reason, a bona fide purpose, or was it created pretty much just to get a tax break? If the main point of a deal is to slash a tax bill, the authorities can call foul.
And when the law talks about a tax benefit, you've got to understand the definition is huge. It's not just about paying less tax today. It also covers pushing that tax payment off into the future or even getting out of the responsibility to collect taxes from someone else. Basically, any move that results in a lower tax burden can come under the microscope. And this isn't some random process. No, the law is super clear about how this works. It's a three-step dance, really. It kicks off with step 1. The tax authority spots something fishy and issues a notice. That leads to step 2, a hearing, where the taxpayer gets their chance, at least 30 days, to explain why what they did was legitimate. And finally, step 3. If the explanation doesn't fly, an order comes down that just cancels out the tax advantage.
Now that rule is great for what's happening inside a country. But the really big challenges? They come from multinational corporations. And that brings us to this huge global chess game of profit shifting. It all comes down to something called transfer pricing.
So the core problem, when you boil it down, is actually pretty simple. Imagine a company makes most of its money in a country with high taxes, but it manages to move that profit, on paper, to a different company it owns in a low-tax country. A classic example is a big coffee company selling its brand name to its own subsidiary in a tax haven. Then the main company pays massive royalty fees to use its own brand, shifting billions in profit out of the high-tax country and into the low-tax one.
Okay, so to fight this, the law first has to define who it's actually targeting. And the term they use is associated enterprises. It's just a legal way of saying two or more companies that are connected. Maybe they have the same parent company, or one has a lot of control over the other, like holding over 25% of the votes.
And when these connected companies, these associated enterprises, do business across borders, well, that's called an international transaction. This is the exact kind of deal that tax authorities watch like a hawk because it's the main way profits get shifted around the world.
So what's the solution? How do you stop a company from, say, selling its coffee beans to its own sister company for a ridiculously low price just to move profits?
The answer is a really powerful concept known as the arm's length principle.
This principle is basically the cornerstone of all modern international tax law. All it says is this: the price for a deal between two related companies, it has to be a fair market price, the same price they would have charged if they were two total strangers negotiating out in the open market. It's all about taking away the incentive to cook up fake prices just to move money around.
And look, the law isn't just waving its hands here. It gets super specific. Remember that associated definition? Well, as you can see, if one company holds more than 25% of the voting shares in another, bam, they're considered connected, and these arm's-length rules kick in automatically for any deals they do across borders.
But you might be wondering, how on earth did they figure out what a fair price even is? Well, they've got a whole toolkit of established methods for that. They might look for similar deals between companies that aren't related, or they might analyze the costs and the normal profit margin for that kind of transaction. The end goal is always the same: find the most objective, realistic price you can.
Okay, so beyond those two huge pillars, the law has a bunch of other specific rules designed to shut down some well-known loopholes. Let's just run through a few of the common ones real quick.
First up, what if a company's deal with a foreign partner just happens to produce suspiciously low profits? Well, this rule lets the tax authorities jump in and basically recalculate what a reasonable profit should have been and then tax them on that number instead.
Okay, next one. Another classic move. You transfer something that makes money, like stocks or a building, to someone overseas so you don't have to pay tax on the income it generates. This rule lets the government just say, nope, we're still treating that income as if it's yours.
And this one's for the financial wizards out there. If someone tries to sell their stocks right before an interest payment and then buy them back right after, just to dodge the taxable income, the law can step in and say, nice try, but that interest is still getting counted as your income.
So, okay, we've waded through some pretty deep legal waters here, from bona fide purpose to the arm's length principle. But let's zoom out. What's the big picture takeaway? Why should you even care about any of this?
Look, these anti-avoidance laws, as complex as they sound, are absolutely fundamental to a functioning society. When everyone pays their fair share, it's what funds the public services we all count on: schools, hospitals, roads. It makes sure that a small local business can actually compete on a level playing field with a global giant. And at the end of the day, it's about maintaining trust that the whole economic system isn't just rigged for a select few.
You know, this whole thing is a constant cat and mouse game. As the economy changes, so do the strategies for minimizing tax. And that leaves us with a really big question to chew on. In a world that's more and more digital, where business is completely borderless, what does the next generation of these rules